Hello friends, welcome. Friend, yesterday I did a video on SUC Waiver, a speculation which I saw in the newspaper that the government of India is thinking of giving to the telecom companies. And the title of my video on this topic was a lifeline for VI, a blow to high frequency spectrum auctions. Now, friends, while I was going through the comments, I noticed a very interesting comment by one of my viewers, which says that these are peanuts amount. How Lifeline for VI am unable to understand. Now, once I saw this comment, let me just blow this so that the viewers can see. These are peanuts amount. How Lifeline for VI am unable to understand. So this gave me an idea to do another video to explain the implication of SUC kind of cash flow and the revenue share, which I have been talking about from the long time, has been negatively impacted the operators. Operators have lost a lot of money because of the transition from fixed license fee to revenue share. So this video, we're going to baseline Vodafone's financial metrics. So I'm going to take you through maybe a corporate finance class for those who probably do not have understanding of this subject matter but really wants to appreciate what is going on with Vodafone Idea like companies. So just be with me. It is going to be a little complicated, but I can assure you that you will be able to understand each and every aspect of the implication of any kind of revenue share reduction. So this comment actually triggered this video. So I'm really grateful to the person who wrote this comment on my YouTube video. So let's go and do the analysis without wasting any further time. So what I've done, friends, I actually have created this Excel sheet. And this Excel sheet is, I'm going to explain step by step so that you understand what is this all about and how there is a butterfly effect. And that is the real analogy of the implication which I explained in my earlier video, which I showed you. The butterfly effect, just remember that, and you will understand what it basically means. Now, if you look at this, this is the Excel sheet, right? These are the workings on this Excel sheet. So what I've done here, and go step by step. Now this block here, I am putting a placeholder of 0 lakh crore rupees of additional government equity. Now we all know that Vodafone Idea cannot live without Government of India taking additional equity because of the debt it carries and the interest obligation that it carries, which has destroys Vodafone Idea's profitability. So the Government of India has no choice but to take additional equity. We all know that. Nobody can escape this. I can tell you with guarantee Vodafone Idea has to survive. So that is point number one here. I have put a placeholder and I'll show you how this is going to matter in the overall valuation calculation. Then this block is the calculation of debt to equity ratio. Now we all know that Vodafone Idea has a market value of debt. Roughly, it is not exactly the same, but it is, you can say, market value of debt are around 2.25 lakh crores. And then the market value of equity is around 0.53 lakh crores based on the current market valuation based on the share price, right? So you go to and you will be able to see that. So the enterprise value will be the sum of these two, which will be 2.78 lakh crores. Now debt to equity ratio will be what? This divided by this, right? So you can see that when you do the calculation here, you'll see that this number comes. Let me just take my face off. So this is the calculation here. You see, the debt to equity ratio is F4 divided by F5, which comes out to be around 4.25, right? So far so good. So you have understood this particular block, right? Now let's look at the cost of debt. What is the cost of debt and how it is calculated? And this is going to be pretty nuanced and maybe circular too. So let's understand this, that how I have calculated a cost of debt of 10.53%, which probably is not the accurate value if you go with the way cost of debt is calculated and how default spread is calculated. So let's understand this and be with me. Don't get confused and don't get overwhelmed. You will understand everything. Now we all know that India's 10-year bond yield is 6.8%. How do I know this? If I go here and I actually just saw, this is the investing.com, I can see that 6.8% is the yield. So what does it mean? So if you are investing in India's 10-year bond, you will be able to get a return of 6.8%, which is a sovereign bond guaranteed by government. So it is the safest return, right? 6 point, you will anyway get, whether you like it or not, whether you go and do whatever with your money, you will get 6.8% return. But is India default free country? No, because every country has got a certain default risk, and that default risk is measured through a spread, and this is based on Damodaran's page. If you go to Damodaran's page, and this is the link that right handed I have, so it has calculated a default spread of 2.18%. Now there is a India 10-year bond yield which is 6.8%, then there is a country default spread of 2.18%, and then there is a VI default spread. Means, what are these default spread all about? Default spread all about means that when a diversified investor who is fully diversified wants to make return on top of the risk-free rate of 6.8%, additional 2.18% in order to ensure that all default risks are covered when he has invested in country bonds of every country. You understand that? So that he does not go down, he remains afloat, and he able to maintain a certain level of profitability. That is the concept of this default spread. So let's say if you are investing in government bond and the any other instrument, you need an additional return of 2.8% on top of the 6.8%, so as to prevent default spread. So the risk-free rate will be 6.8% minus 2.18%. Now, additionally, when you have a country default spread and additionally you have a company default spread, means the company can also default. So you need to make an additional extra money if you are investing in company bonds. For Vodafone Idea, interestingly, this number has been quoted as 1.55%, and I'm going to show you how this number has been calculated, because this is pretty important. Let me show you. So if you see here, I'll just show you, this is the rating for Vodafone Idea by CareEdge. Now the CareEdge is given a rating of B++ stable, right? Now if you go to the Stern web page, which kind of maps the rating with interest coverage ratio. So I'll show you that this rating is this. This is the rating. Where is it? This rating. And it assumes the interest coverage ratio between 2.5 to 2.499, and that's how you will be able to calculate a default spread of 1.55%. Now Vodafone's interest coverage ratio. Now before I basically talk about this, I need to explain to you what is interest coverage ratio. Now for you to understand interest coverage ratio, this is where I am going to Investopedia. So what it is saying, interest coverage ratio is EBIT divided by interest expense. Now basically what it means is that whatever earnings that you have, right, before interest and taxes divided by the interest expense will give you a certain kind of benchmark that whether you are earning enough or not to pay interest. So whether your default risk is high or not, because if you are not able to pay interest, you are definitely going to go bankrupt, because that is a commitment to the debt holders that you have to keep on paying. So the interest coverage ratio is a very important marker to calculate default spread. Now this is where how the default spread is calculated. Now you are assuming an interest coverage ratio of 2.25, which I think is not the correct interest coverage ratio, because the Vodafone Idea's interest coverage ratio is actually negative, right? Because it is so low that its earnings are basically going to be less than what interest that they are paying. Means actually not negative, it is in fraction. So its default spread will be pretty high. But instead of that, what we had taken a default spread of 1.55. Now you will tell me why have you taken a default spread of 1.55%, and why this company who is a respectable company is giving Vodafone Idea a long-term banking credit rating of B++, which maps to the default spread. Now to answer that question, I'll just go back to my spreadsheet again. It is very simple actually. You know why? Because everybody believes that the government is going to bail Vodafone Idea out. Therefore, Vodafone Idea is getting a lower default spread. If the government would have said that I don't care about Vodafone Idea, let Vodafone Idea go to hell, this number would have shot up significantly, with which, and because of that, the cost of capital of Vodafone Idea is also going to increase, because the cost of active capital is a sum of all these three. It is currently showing up as 10.53%. Now, why I am telling all this, you'll be able to understand as we move forward in time with this presentation. Just be with me. So, this cost of debt is actually higher, but market has already factored in government support, and therefore the cost of debt is lower. Do you understand now? Now, let's come to the cost of equity calculation. Now, company has debt and equity. Now, in order for you to calculate cost of capital, which is going to be the discount factor on which I am going to value the SUC, which I had calculated earlier because of the waiver of SUC, which will have a butterfly effect, I need to calculate cost of equity. Now, for cost of equity, how do I make the calculation? And let's understand the fundamentals, how to calculate cost of equity. Now, there is a concept called equity risk premium. Equity risk premium means that how much risk, right, the investor is going to give to equity, means how much risk it perceives when it investing in equity, which in turns and other words mean that how much returns that it is going to want by investing in equity to stay afloat, stay above water, right? So Damodaran is saying that as of 1st January 2025, it is 7.26% of the is for Indian market. Now, in order to calculate cost of equity, the CAPM model, right? So what it basically tells you that you have to add the risk-free rate, and then you have to multiply the cost, the equity risk premium with beta. Now, what is the concept of beta? The concept of beta is volatility. Let's say if you have a stock whose price fluctuates in the market in a volatile manner. Now you have to exit the market at any point of time. So you will carry a higher risk because you will not know what time the market has gone down and what time the market has gone up. So this is the curve. So you don't know because you may need money at any point of time. So this volatility of the stock price of a particular company is an indicative of beta. Now for a telecom company, because these are sector specific, for a telecom company, this beta, which is called unlevered beta, is 0.92, which is as per Damodaran. Now, how do I calculate the overall cost of equity? By using ERP and unlevered beta. Now it is very simple. What is risk-free rate? As I told you, risk-free rate is this minus this minus this, which I have captured here. India risk-free rate of 4.62%, because this much return you have to make by investing in a risk-free return. The ERP for India is 7.26%. Then you multiply that with the unlevered beta. Normally, if there are no other risks which the company carries, then this will be what? This 4.62 plus 7.26 multiplied by 0.92. Will it not be, right? But Vodafone Idea has got some additional risk. What are those risks? Which is directly linked with the debt that Vodafone Idea carries on its book, which is significantly higher than its market value of equity. Because of that, the beta, which is normally for a stable telecom company of 0.92, has to be enhanced by the debt to equity ratio, and that's how the levered beta, which is the beta which is levered, which includes the tax part also, because when you are investing in debt, you get an interest subsidy also on account of tax. So you get a levered beta by using this calculation, which is F16 plus 1 minus F17, which is the tax rate, multiplied by F7. F7 is this value, debt to equity ratio, which I was telling you, right? So you get a levered beta of 4.1 ratio, and then in order for you to calculate the cost of equity, what you do, you add the risk-free rate, then multiply it by the ERP, which is of F15, which is here, this one, and then you multiply this by this one, this value. then you come out with a number of 34.41%. Now you might, somebody might be, the people who are watching this video will be very surprised that, the cost of equity for Vodafone Idea is 34.41%. I told you, look at these numbers right in front of you. These are actually, you can say, optimistic numbers as regards the debt that Vodafone Idea carries, right? Now, what is cost of capital? It is a weighted average now, right? The weighted average of this number and this number, depending upon the market value of debt and equity, which comes out to be 15.08%. Okay. So, in nutshell, what is this telling you till now? Because there is a lot of things to cover, going forward. We still have 5 minutes before I end 20 minutes, threshold of my video. This is 15.08%. So if you find here that the cost of debt part is reasonably kind of, I can say that stabilized because of the government guarantee. It's like, some unwritten guarantee of the government that the company will keep afloat, right? The cost of equity has an element of debt, right? So this number is inflated. So this debt to equity ratio is not probably the right reflection of calculating the cost of equity. So maybe this cost of equity number which I've calculated is likely inflated. You might feel, because if you are able to drive down your cost of debt, so would the cost of equity would get driven down, because you may not use the debt to equity ratio of 4.25% to create a levered beta, because levered beta is an indication of volatility on top of the unlevered beta. Now you understand what I'm talking about. So this is also inflated number because of the government guarantee. Okay, now let's talk about the growth rate of Vodafone revenues, which typically I can assume 11%. You can change it depending upon what you want. Now you have an SUC outflow saving, which you can clearly see from my website. Where is my website? You can see that Vodafone Idea in till date, till March 3rd March 2025 in the Saras website. If I choose FY25 under this banner, or let my website, yeah. So just go and make a change here. I'll take Spectrum outflow, and then Vodafone Idea 354.1. is the GSM part of the SUC, which is going to be impacted by waiver, right? Okay. So I can assume that maybe it is 360 crores, right? Because if this waiver is given, it will be 360 crore plus the return of spectrum. So this may be little higher, because the higher frequency spectrum will get returned. So this number will be little bit higher, but forget about the return part. Let's look at only 360 crores. Where is my website page? Here. So this is 360 crores. I have to calculate present value for 360 crore. Now the PV calculation. Right? If I were to do a PV calculation, let me show you how the PV calculations are done. For that, I have to go and show you a working that I have created, which is going to give you a little bit of idea, and people may skip this video, this part of the video, those who are not interested. So this is the PV calculation derivation. So the SUC cash flow is what? C1. It's a growing perpetuity. C1 cash flow C1, which will increase in forward with time depending upon the growth rate. Discount, which is the cost of capital, is R. The revenue growth rate is G, which we saw as 11%. So you have a PV of SUC, which is going to be discounting of all the cash flow, like C1 will be multiplied by 1 plus growth rate divided by 1 plus R square, and like that. So this is a geometric series, right? This is a geometric series. Now, if you sum this geometric series by using this calculation, you come out with a final value of C1 divided by R minus G. And on the basis of that, what I have done, I have calculated the PV, which comes out to be 8,816 crores. Can you see this? Now, this number again looks like maybe a plum. It may not be a peanut, because by looking at this 360 crores, it was appearing like a peanut. But this is 8,816 crores of present value of the SUC, the perpetual SUC, right? Now let's do some tweaking here. Assume that the government takes an equity from Vodafone Idea to the tune of 1 lakh crores. I'm just making up a number. So what will happen? This number is going to decrease. The market value of equity is going to rise at the same market price. But this is not an accurate number. I'm just basically making it up. So your debt to equity ratio is going to go down. Keep the default spread same. Can you see now this number has grown to 14.990 crore. Now let's do the following. This is a reasonable assumption to make. There are 1 lakh crores of, let's say, equity is taken, you can tweak this number here and there. But let's now play with the growth number. Let's make it 12%. Now you see 25,000 crores, right? If I make it 13%, it will give you 89,000 crores. So this peanut has become a football stadium, right? So now you understand the implication of what I'm talking about. So this is a butterfly effect. See, butterfly effect means that you tweak the revenue share regime is such a big problem for the mobile industry. People are very happy with revenue share, and I've been telling from the very beginning is the worst thing anybody could have done with the mobile industry, because a perpetual cash flow, if you do a present value of perpetual cash flow, you can imagine the kind of money that you end up losing. So anyway, this might look a very small number. It will be a very big number if you are able to tweak these numbers properly. So for a stable company with a large revenue growth, with a expense which is very, very less, with interest coverage ratio which is pretty high, you will find that your cost of PV of SUC is going to be pretty high. So I am basically want to tell you that I'm going to stop here, because this is going to be a very long video otherwise. I just want to give you a sense of perception that how Vodafone Idea's cost structure have a huge implication on its valuation, and any savings on the top line can have a significant impact on the company valuation. That is what the game is all about. And if the license fee currently, which is 8%, if that drives down significantly, you can imagine what is happening. That is the reason when the government came out with zero SUC for all spectrum auction, which was held before 2022. You can understand the implication on the mobile operator, which went unnoticed, because this is the way you have to do the calculations. You understand what is the implication of SUC? All those things, spectrum price, etc., because it doesn't matter. What matters is that if the government is charging a share of your revenue or not, and what is the value of that share that the government is charging, that is where the maximum impact is, friends. You got it now? So let's get back to the same video which I basically did yesterday. And I think the friend who asked me this question, these are peanut amount, how it is a lifeline for Vodafone, probably might have got his answer. This is a butterfly effect. That's all I would like to call it. The best analogy is that. Thank you, friends, for your time. I hope that you have liked this video. And if you need any further clarification, I'm very happy to provide those clarification as and when you need it. Please post a comment in the comment section. I'll come back with a new video next time on the new topic. Thank you very much.